What a way to close the week for the S&P 500. What has been a pretty decent past few weeks, 3 weeks for the S&P. So I'm going to break down how that all might be coming to an end early next week, at least in a small way, before things take off. I'm going to talk about why and what technical signs lead to that, especially considering how extreme today's move has been. And we're going to talk about what's driving this action, why today's breakout was such a good sign for an intermediate trend that we expect for multiple months going forward from here, even if there might be some short-term dips in between. What's driving that, why I liked today's breakout, in particular in this week's breakout, more than the past couple. And then also with today's trade idea, we'll talk about how to take advantage if we continue to get a decent bullish run, where it's a good opportunity to get a decent reward to risk ratio on that. So let's go ahead and get started. Today is Friday, November the 1st, 2019. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500. Look at this nice little close to the week, closing at the high of the week. It's a great move here. You can get rid of the retracement here. Now, and here's the problem. There's a retracement of this near-term run. So here's a little bit of an issue, and that's an extreme move high. In fact, we almost got an oversold cluster with the near-term line. But that near-term line now has been up here 17 days. And so when you consider like the typical time frame, 7 to 12, and we're looking at 17, strong bullish posture, the intermediate line, very, very high, momentum line hitting extreme. That's a good level. You can kind of see the momentum line kind of hit an extreme at the end of this near-term run. It went up for a few more days, but you had a big, long, relatively long, extended near-term rally there, and it finished with a strong peak to the upside, a little kind of like a blow-off top. Now that turned into the intermediate pullback, and I don't think we'll get an intermediate pullback on the next go-around. You can see too, some other long, extended near-term rallies. This one started with a big move up on the momentum line, and you can see here, same thing on this near-term rally, started with an extreme move on the momentum line, relatively extreme. So these last couple of extended near-term rallies have potentially finished on an extreme move in the momentum line. So keep that in mind. Not that I think we're going to pull back anytime soon to any significant levels, but of course, the 23% Fibonacci retracement is the first area of support on any near-term pullback, which would bring the blue line below 50. You notice that does happen. I mean, even during intermediate rallies, you'll get multiple near-term pullbacks. So, we can't not have a near-term pullback. As good of a day as we had today in our class portfolios. We had a really good day in our class portfolios today. But regardless, despite that, we're going to get a near-term pullback, and it's going to bring, your portfolio account values will oscillate, hopefully to the upside, but they'll still oscillate while moving to the upside. So don't panic, don't worry if we pull back down towards 3022 early next week or sometime next week, simply because of how that we've had this long extended near-term rally, longer than normal, and it may be punctuated by this extreme close, similar to this one here on the momentum line. That one lasted another day. That was September 11th, so it was actually the next day. It was middle of the week here, and then it peaked, and then the near-term line pulled back. Now again, like I said, I don't expect an intermediate pullback like this to come out of this, but just the near term down to this 3027 at some point in time. After that, the intermediate run is just starting. Dark green shading, dark green line, momentum line rising above 50, and that's not just the case for the S&P, but it's also the case now for the Russell. Look at that breakout on the Russell. So still not quite all-time high, or even 52-week highs, but still that's the highest close on a daily basis that we've had for months. So very, very good move. In fact, the Russell 2000 finished with one of the strongest performances of the day, 1.7% here. So very, very good performance for small caps, which is necessary. And you can also see, look at crude oil, which again, it's really necessary if we're going to get a good extended intermediate rally, which is what we expect. actually, which is what I expect. I don't want to speak for Brandon, but I would assume that he's probably in a similar camp. But at least what I expect here is a pretty decent intermediate rally, multi-month to finish out the year into next year. You can't have that without participation broadly from small and mid-cap stocks as well as commodities. And we got that in a big, big way today with small cap stocks bouncing back up off of this near-term low point that it formed here below 50, which would have been ideal if the S&P would have done that too. And the extreme high in the momentum line. And then again, rising market sentiment that is just barely crossing 50 on the Russell 2000 with the green line. So very, very good pattern here across the board. You can see the NASDAQ composite giving us it did give us an oversold cluster, overbought cluster, excuse me, but in this case at the beginning of an intermediate rally rather than at the end. Again, with it, considering that the intermediate line crossed above 50 here in middle of October, we're just halfway into the first month of what can be a 1 to 3 month intermediate run. So I would consider that still. Obviously, hindsight's going to be 20/20 after the fact, but going into this day, I would consider that we're probably closer to the beginning of this intermediate run right now than we are the end. If we continue with that type of multi-month rally like we had over here, and not like this one that we had here. The difference between now and this one is we didn't get up to a new intermediate high point on this, and we have already here. In fact, again, new all-time highs. And then you look at the Dow Jones Industrial Average, also coming close to a cluster, and it's pretty close as well to getting new all-time highs. Strong bullish posture, strong market sentiment. And again, that October 15th, kind of towards the beginning of what can be a pretty decently strong intermediate rally. All right, before we go on and look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video that will notify you when these videos are posted. Also, hit the thumbs up icon that's down below there. That tells us, number one, that you like the video, of course. But it also tells us that you want us to do it again on Monday. So it's our survey. It's a very quick, easy way for us to see what you think about our videos. So if you like it, if you want us to do it again, just hit that thumbs up. If you don't, then don't hit anything. That's, again, we don't send out surveys, so that's really what we look for day in and day out. Also, while you're down there, comment. What did you get out of the video today? Subscribe to our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It will take you to our free subscription page. You get access to our market commentary section of our blog, as well as our market outlook forums, among other things. So click on that link to subscribe. Follow me on Twitter for more content in between these videos from day to day, and join our Facebook group that we've created for our market outlook videos. All right, also I wanted to point out a couple of changes that we made on our blog here. If you see, here's my most recent market outlook video. Of course, we do live market outlook videos at 3:30 p.m. Eastern time every time I do the video, where I go back and review all of my trades that we do in the trade ideas that we put out there. We follow up on those trades all the way to the close, to the time that we close. I talk about how we manage them, how we close them, how we manage the risk, all of that. So we do that in these live videos. You get access to that as a Plus subscriber. You can see I've added a link under the pricing so to see what that is. Of course, our premium subscribers get access to everything we have. I've also added this link. This link here in the Market Outlook in the menu takes you to the most current Market Outlook post. You can get to any of the archives by clicking on the blog archives, getting down to Market Outlook. That will take you to our archives. But that will also, you can see we also have the live trade review link there, as well as access to our forum. Remember, that's for free subscribers. And then finally, I've also added our forums for all of our classes underneath the trading room. So if you click on that link, that takes you to our calendar, and then mousing over the link opens up the links to all of the class forums where we put all of our custom content for those classes, including scans, scripts, etc. All right, let's take a look back on the weekly chart, and you can see here, let's go back to the crossover, very bullish candle this week on the S&P from a Hakunashi standpoint. The Hakunashi close, which is different than the normal close. See, we closed this week at 30.66, almost 30.67 up here, but the Hakunashi close for the week was at 30.47 because that value is an average of 4 values, this week's open, high, low, and close. on the S&P. So when you average those four numbers together, you get 30.47, even if the actual close, which is one of those four values, is at 30.67. So when you get that average to close above all these high points, that's a breakout pattern. That's a very, very good breakout pattern. Very bullish response. You look at the Russell 2000, it's getting a golden cross. Now, it's had this golden cross before, and we haven't quite closed. So I'm going to say getting above 1600 on the Hakenyashi will be very bullish for the Russell. So if we can get that next week, you can see the actual close right now is at 1589. So if that ends up being roughly the open next week, that will be one of those four values. And depending upon where we close and where the high and the low of next week is, if we can get those averages to be up above 1600, that will be a similar breakout for the Russell 2000. Would really kind of show that we are well on our way here. There's your NASDAQ composite with that same pattern, and the Dow not quite with the same breakout yet either. If you look at, I always like to look at these top 5 companies in terms of market cap it's not necessarily FANG because Microsoft takes the place of Netflix, but you can kind of see, it's not quite breaking out itself yet either, those 5 stocks. But, looking much better. And, once you do get more of a breakout from those, then look out, right? Look out from a market perspective, because you can see, as I mentioned in my technical analysis class, as big as those companies are, they've actually been a lot more correlated with the Russell 2000, more so than the S&P 500. It's sideways as we've been all year on the Russell, same on those stocks. So, that would be another representative of risk appetite breaking out to the upside, in addition to small cap stocks and as well as crude oil. 3 green arrows, very, very bullish pattern, a little bit above average volume today too, 70 million shares trading hands. When you look at, the 2-line version of that chart, you can see we're well above the 8-day moving average. We kind of tested it at the low yesterday. The MACD histogram's turning back up. The MACD value itself is up pretty high. The average of that's not nearly as high yet, so it's got some room to not only get up higher, but stay up higher, as you can see in some of these other charts. Not as big of a surge in the momentum as we saw, like even here, or especially over here. Obviously, we also didn't have as big of a low point to come off of as some of these others on the MACD histogram. So, as well as the absolute value of the MACD, it was not nearly as negative as what we saw before. So, we don't have to have the same surge. In fact, you might end up more with kind of a longer MACD histogram than a big peak because of how we can just grind our way, especially with volumes as low as they are. All right, now let's take a look at the intraday chart here for the SPY, and again, see how bullish we are. We're going to lose this here in a few days next week. By Wednesday, we'll lose that low, and that low will start to really ramp up, which will open up room to the upside for us to keep going up. It's that 5% mark, which is about 15 points, and we're looking at about a, 12, 18 point run. So we're pretty extended. The rubber band is stretched in the 4-week range here. When you're bullish, it's hard to maintain a big without the rubber band pulling back a little bit. So that's why I say don't be surprised if we might stall here because of how bullish we've been. Allow this low point to start moving, because it's only going to, by next week, this comes off here today. 1, 2, 3, 4, 5. By next week, the low point will be here, and we'll have the low at about 295. And now we'll just have about an 11-point range there. So less than 5%, and that will allow the rubber band to stretch more. And even then, after one more day, next week and one more day, it will pop up to this 297 area. So you see how that kind of bringing this up will allow this to go up without stretching that rubber band out too far. It stretches out too far, which is essentially what happened, with that momentum line spiking up to a high extreme level, that stretched the rubber band out. And we don't, you don't want it to break, but it will stretch it out, and now it's going to, expect the market to pull it back, not necessarily come down, but at least stall while these lows come off. Right, these days come off the 4-week window. It's kind of this rotating 4-week window. These come off, and that low tag moves its way up. over the next week and into the following, what would be November expiration week. But if you look at the range and the volume here today, you can see the range. Again, you have to consider the gap. So we closed at 303.33 and the low was at 304.74. So about 1.5 points almost of a gap that we have to incorporate here. So we're looking at about 2.9. So we had above average range, including the overnight trading, as well as slightly above average volume at 70 million. So you put that into context here. Almost 3 points range is right here. It's not going to stay above there, otherwise, because if these lines go up, that's bearish. So don't expect it to stay there. We just, that's a little bit of a breakout move. That's why it's so big. Expect us to come back down below this 2.7 level, and the volume to come back down. 70 million right there. Expect it to come back down towards this 50 to 60 range. But with the ATR, relative ATR still below, even that 2.9, including the overnight trading, is below 1%. Of the price of the index. So that's going to keep the average, the ATR below its 1% mark too. That's like entrenched bullish trend territory. Just to kind of give you an idea of what that looks like on a long-term basis. Here is, if I draw a line at the at 1 here to go along with that dot, basically extending out. Well, I can extend out. Can I extend out that dotted line? Let's see here. Extend to the left. There we go. So there is our 1% level, and you can see when you get bullish, you can stay below 1% for a long time before we get overextended. And I don't believe we are overextended to the upside in the least bit. Now in the short term, a little bit, right? So when you look at the volatility index, we didn't close. We closed the day below over here on October 30th. We closed below the 80% mark. I mentioned how that's the first time we've done that in a long time. Well, we did bounce up in volatility on Halloween, and then we ended up closing down again. So we didn't close the week below 80%, but man, we came close for the second consecutive week. We closed at 80. Let's see, it was at 85% last week, and then this week at 82%. No, excuse me. No, we did close 70. I'm looking at the wrong number. This number right here. So last week we closed at 80.5%. This week we closed at 79.75. So it's a smidgen below that 80%. Again, the first time we've closed below 80% since the week of September 17th, 19 of 2018. So that led to a little bit of a pop in volatility. Again, don't be surprised if, and again in the short, and I don't even think we have to get all the way to above 15. But even if we do, not a big deal whatsoever. Remember the thing I always look at on volatility is its range, and last month's range for volatility was 9 points. That's if you look at the average range here, see this one right here, and then go to VIX, and then look at the monthly chart here. You can see the average range is 8 points, 8.17. So last month we had 9.25. This month we are less than a point because we're only a day into it, right? So if we're going to be anywhere near 8 points, we're not going to drop down to 4 on the VIX. We might drop down to maybe like 10 or 11. So that's a point or two to the downside. So if we get down to 10 and we peak at 15, that would be a 5-point range, which would still be below average. So, don't be surprised if sometime during this month we don't pop up towards this 90% mark here and pop up towards 15, especially considering how low we are. And I would expect that to occur sooner rather than later, simply because of where this volatility, this near-term line is, 17 days in, and this extreme high in the momentum line occurring so late in a near-term run. All right, so to summarize our technical outlook before we look at what's driving the market and these different relationships, as well as our trade idea for today, we have a strong bullish posture, and we're getting some participation in other risk asset classes that we need. Very, very good into the week. We are overbought even more so now in the short term, more so than we were on Wednesday, with today's rally and close at the high. So don't be surprised if we get a little bit of volatility here early in November before we continue this intermediate run through the end of the year into early part of next year. Lots of reasons, and I've shared a lot of them on Twitter. retweeted a lot of data points that would give us expectations that we're going to finish this year strong. Of course, anything can happen, but that's that the market forecast is supporting that outlook right now. So what do you think? Do you agree with that, or do you disagree? So I want to see your vote with that link right there. Click on that link. It opens up a poll. Then hit either agree or disagree. As always, if you click disagree, which is perfectly fine, right? Like I said, I'm not a chart master in any degree, self-professed chart master. But if you disagree, scroll to the comment section down below and comment. Let me know what you see differently. And maybe you happen to be more bullish. There can't be that much more bullish than I am. But maybe you don't think we'll have a near-term pullback for whatever the reason is. Or maybe you're a lot more bearish than this. Let me know with what you're seeing, not just your opinions, as of course, but what's driving your opinions. What indicators, what charts are you looking at that give you those opinions? Because you don't ever want the market to do what you want it to do. You have expectations based off data points that are feeding and building those expectations. So share those if you'd like with our Market Scholars community and Market Outlook viewers. All right, now let's pick up with what's driving the price action. And I want to take a look at the asset class comparison chart here for the week. And you notice that at the beginning of the week, treasuries were holding up really strong coming out of the FOMC meeting. We had the FOMC meeting here. We had Apple earnings this week, Facebook earnings. We had big tech earnings. It was a big week. We had a PMI number today. It was, and PMI number yesterday, ISM number today, that were all they're below 50, in contraction territory. But I think the market kind of views that as, these indicators are hitting lows, are basing, are bottoming out, are forming the low numbers that we're going to bounce off of, as there are pretty much zero expectations that we're heading into a recession. So as a result, you notice that treasuries pulled back a little bit today. They're still up for the week, but look at small cap stocks. They had a strong week, pulled back after the FOMC, but then finished the week with a 2% gain. Very good week for small caps. Crude oil was down 5% at one point in the aftermath of the FOMC meeting. It rallied up strong. It was only down 1%, so a very strong finish to the week as well, along with small cap stocks. You can see international stocks doing well. EFA and EEM both rallying too, with weakness in the dollar. The dollar finished down, even though the Fed was probably more hawkish. I would expect that relationship to be a little bit more temporary as yields bounce back up. Yields had a down week here. And let's go now to this chart, the 12 grid here. You can see that yields ended up with a relatively down week, bouncing back up here today. Crude oil, you can see the breakout it had, and there's gold. If I take a look at the dollar index here, very oversold. In fact, if you look at here, let's maximize that sell, and let's look at the 5-year or a weekly chart on the dollar index. So you can kind of see how we're still at some support level here, where this Fibonacci retracement zone bottoms out. The momentum line is still in the reversal zone. We have this bearish intermediate posture on the weekly basis. In fact, if you take a look at it on this chart, we can see those indicators. So here is DXY. So as bearish as it is, this is on the weekly chart. So red line, light pink shade, not dark green yet. If we break down below here, then it's bearish. But I expect this is probably suckering in a lot of dollar bears and gold bulls, because if the 10-year note rallies up off of this level, and this is going to be interesting because if the market believes the Fed is done cutting rates, yields will start to rally. So the question is, does the market believe the Fed's done cutting rates? And so far this week, kind of in the aftermath, you got a little bit of a bearish engulfing at resistance. So how much of a sucker pattern is that going to be? Or are we going to retest down to this 1.5% level and potentially go further down? Or are we going to kind of break out, kind of a little bit of a cup and handle pattern, hit this low point around 1.75, 1.7, and then turn back around, which would be the expectation. considering the move, the expectations with Fed policy, that they're done cutting rates. So with that being said, that typically would be dollar bullish if that were to happen. You can see that generally the dollar moves in conjunction with yields, right? When the yields go up, so does the dollar. The dollar's in this purple line here. When the yields go down, so does the dollar, and yield goes back up, and a little bit of a downward move here as yields kind of broke out, but then as yields continue to move higher, the dollar really caught up. Well, here the dollar might be catching up to the downside. Yields have taken off to the downside, and the dollar hasn't participated. So I wouldn't be surprised if at the beginning of this yield breakout, if the dollar pulls back down to catch up before breaking back out to the upside. Again, another idea behind that is the dollar's a safe haven too. And right now, one of the reasons why we're so bullish is because we've been so bearish. The safe haven trade, even though we haven't sold off significantly in small and large cap stocks. In fact, you look at, I changed that comparison to SPX here, and you can see even though you can see this typically goes up together, even though bonds continue to rally for most of this year off of this level, stocks really they never they never pulled back in conjunction with that. I mean, it's some volatility or ups and downs, but they never really pulled back here. Big glaring difference. So something's got to give. Either stocks are going to pull back down here and fix this divergence, or yields are about to make a big move to the upside to catch back up. And considering the market posture, I think the latter is more likely than the former, especially with the Fed potentially being done cutting rates, which is what I expect. I think the Fed's all along thought, they're going to try to do a similar policy to the mid-90s, 3 25 basis point cuts or as many as they need, and see what happens. And now they've done that, and I think they've pretty close to fix the situation you need with the 10-year note here minus the Fed funds rate. It's got to be updated as of here yesterday and then today. But you can see, as of the day before Halloween, we almost, as after the FOMC meeting, we almost got the 10-year note back up to where the Fed funds rate is with that last drop. So now you don't have nearly the same impetus to drive to work to continue to cut the rates lower with that inverted yield, that particular inverted yield curve not below zero anymore. Our yield curve not inverted anymore. If we take a look at the inflation expectations, which again is updated through yesterday, this is a little bit of a concern. It continues to really drop down, and until they can get a stranglehold on that, and it breaks this trend, however you draw this trend line, but breaks that trend line and starts to work back up above to new highs, then there will at least be some odds that there will be a rate cut, even if they're not high probability odds. But there's 12% odds. If you look by next April, which is something we've been kind of watching, you can see the odds for a rate cut are about 55% now. So it's not high probability. It's a coin flip. It's a leaning towards a rate cut. But the reason why that is where it's at is because we still haven't got a good base hold yet on inflation, even with the yield curve itself. Not as inverted as it has been, inflation expectations are still hitting lows for the cycle, and that needs to change for the Fed to be officially done. So even if the expectations are that we're not going to get a move to the upside, we're not going to get another cut in December at least. After that, the odds start to change. You got a third of it, 33% chance, roughly 35% chance you'll get one in January. You've got a 48% chance, so less than 50-50 in March, and we finally get above 50-50 in April, and we finally get to 60%, which is kind of that high probability mark, by next June. That's a long ways out, and a lot of things can change. And you remember, from an economic standpoint, we are closer to lows from an economic indicator standpoint than we are highs. I mean, we pull back towards zero on a global and a U.S. basis, but we're still bottoming out. We have this bottoming out process that started where we peaked was August 2018 from an economic standpoint. When you look at these indicators on year-over-year levels, those charts peaked in August of 18, and we're in the process of bottoming now. And as we bottom and roll up, then you'll see these numbers start to drop off. And potentially, I mean, not necessarily get up to 50 or 60, but those numbers start to rally up. And then you'll see yields really take off and catch back up to stocks. If you take a look at this relative rotation graph, you can see the relative strength for these are all safe haven asset classes relative to the benchmark that we use for our portfolio management class, for our equity portion of that portfolio, ACWI. Excuse me, this is on a weekly chart. And, it's good to be in the green. It's not so good to be in the red, and that's where they're all headed. These are all the safe haven asset classes. They're all been in the green. They've all been in the green here. Just as of just a few weeks ago, but now you can see they're rotating back around relatively quickly in the wrong direction for them, which again, this illustrates what I've been mentioning for a while now, that the pain trade is the safety unwind, the safety trade unwind. And you can see how that's happening here in a relatively big way and should lead to some more upside potential going forward from here. You also see it in the sector rotation. If you can see that, the safety trade here, let's get this. The safety trade, utilities, real estate, and staples, they still have pretty strong relative strength. So that just means that there's a lot more unwinding left to go, and they're moving in the wrong direction too. And on the other end of the spectrum, the first sectors to do really well. Technology has been a strong sector in and of itself. The first sectors that start just doing well is healthcare, financials, industrials. They've been the most beaten up. And watch for its discretionary and communication services to make its way. Energy, it's got a lot of momentum. It's got the most momentum out of any sector, but it's so beaten up. It's got a long ways to go before it be, it's more than likely not going to get above 100 from being that low on the relative strength. If you look at it here on this chart, on the chart that I have, that we have right here on the sector grids, you can see here that, there's utilities and real estate, dark pink shading on both those sectors with yellow lines that are flirting with red, red lines there. So, but you also have, there's energy. Energy looked bullish today, but it's got a yellow line too and light green shading. Everything else is dark green and everything else has green lines, except for energy, like I said. Everything else has green lines, including now discretionary and communication services. So the more that those start to grab the baton away from these losers, not that they're always losers, but they have been the biggest losers. You don't want an intermediate trend. It's hard for it to sustain itself on the back of the oversold losers bouncing. That usually will start it, but then you want the typical leadership up here at the top to take hold. And in a bearish dollar environment, you would include these energy material sectors too. But for the most part, you want these areas to take hold, and you can see technology is, and now you want to see over the next few weeks, probably not next week, but over the next few weeks, you want to see discretionary and communication services join them. All right, so for our trade idea of the day, and remember, if you want to watch these trade ideas, if you want to watch me manage them all the way to the time that I close them out, it's one thing to actually open them because anybody will tell you trade ideas, right? The point of us is to show you trade ideas that are representative of what we teach you in our trading rooms. But also, the most important educational value is actually manage those ideas. And that's what we do in these Market Outlook Lives at 3:30 p.m. Eastern Time every day. And you can link it here off the blog, or you can just mouse over Market Outlook and link to it right there with a live trade review. Today's trade idea is on Netflix. Let's take a look at Netflix here. It's been really beaten up. I think with this idea that the market was pricing in the Disney Plus and the Apple Plus products being released to market and the negative impact that can have on Netflix. I think that pricing in has been done. And in this kind of buy the rumor, sell the news, in this case, sell the rumor and buy the news. I think we were selling the anticipation, the expectations of these services having a negative impact on Netflix. Now that they're being released, it appears that there's a buy the rumor, and the idea that what's good for for Apple and Disney would also be good for Netflix as more and more people stream. There's not a there's not necessarily an either or here for those products. And I think the idea is if more and more people use those streaming services, they're more likely to cut the cords, those that haven't already, and switch over to these particular products. So dark green shading, green line. We have 3 green arrows on the 3 green arrow chart here from Netflix. You can see from a long-term perspective on the 1040 cross, Netflix, you've broken back above the 50-day moving average. You've got the opportunity to fill in the gap up to around 315 from pretty significantly low levels from a PPO standpoint, at least compared to the last 3 years. This is about as bearish as it's gotten. If you look at its Bollinger Bands, you can see we're back into the value area, and you clear this level and it's got plenty of room to go up to 360. Whether it gets there by December or January expiration remains to be seen. That's a lot of potential move because we dropped so fast from 360 down here to 290. We dropped so far so fast that it left a hole in volume without much resistance if we were to make our way back up to the upside. If you take a look at its DMI chart, you can see the positive is crossed up above 25, the negative is crossed below 20. That's the pattern you like to see from a bullish standpoint. A little bit of a short-term pullback here. If you take a look at its Ichimoku cloud, we are up above the blue and the green lines. The green lines pulled back a little bit here, but we're now into the cloud, and you can see how we don't even have to go higher for us to get out of the cloud here by November expiration, much less start to move our way up. You know, getting above 294 will get you out of the cloud in the next week or two. So we've got good opportunity here to the upside. Here's the 2-line versions of the 3 green arrows. I didn't think I showed you this one. The 8's above the 17. They're both above the 30. The moving MACD, the moving average for the MACD is up above 0. The orange line's up above 0, and you can see the stochastics is crossed above its moving average, with it turning up too. And then this impulse chart that I shared in today's technical analysis class, you can kind of see how we switch from kind of a bearish to neutral reversal and now to bullish. Getting up above the 50-day moving average, a rising 50-day moving average with a rising MACD histogram on the weekly chart. So some opportunity there for some upside as well. So with that being said, let's take a look at what trade we did. This is from an old class trade. Here's our new one that we've done. And you can see we sold the 305 call and bought the 300. So we bought an out-of-the-money call option essentially below 40 in the delta. We financed most of that with this short call. So we're capping our gains off at 305. And so because of doing that, what we've done here is, and here's the trade right here, we've limited our loss to, let me put it on so you can see it on a per contract basis. Remember, we put these trades on during our Market Outlook Live, so that's why you see that here. But we cap our loss to $157, and we put half of that at risk. So we position size around the 157, worst case scenario, but we'll keep our loss hopefully limited to half of that per spread. So about $75, $75 plus dollars, with a potential reward of 343. So if we get above 305 and stay above 305, so good reward to risk ratio. Again, by the time we position size a normal position around maximum loss, knowing that we'll probably only take half of it, so that we keep our loss small, and for about $400 and what would that be, $65 of risk, half of that 930, we're going for a $2,000 plus reward. So better than a 4-to-1 risk reward ratio here if it breaks above that resistance and continues to move higher. All right, well, that does us for today. As always, you've heard from me now. Now I want to hear from you. Use that link that's popping out that takes you to our Market Outlook forum. Remember, you have to be a subscriber, but you can do that for free. And let's keep the conversation going over the weekend. If you have any questions or comments about anything we talked about in the video, or for that matter, anything we didn't talk about that pertains to the topic, open up a thread and let's keep this conversation going. Reply to other people's threads, and let's talk about it. Again, thank you for watching. Remember to hit subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video down below. Follow me on Twitter for more content in between the videos. Join our Facebook group. for our market outlook and subscribe to our site. Have a great rest of your weekend, everybody. Thanks for watching, and we'll see you all next time.